Here we're just been going over an overview of this MACRS tax depreciation system, and this is a requirement here by the Internal Revenue Service of the United States government for corporations when they're depreciating their assets here for tax reporting. Again, what does this MACRS stand for? Well, that's stands for the Modified Accelerated Cost Recovery System here. So that's the abbreviation here for it. And what corporations normally do is they're using GAAP here for their book depreciation, but for tax reporting and taxes, they have to use this MACRS system. Okay, so the MACRS depreciation tax basis, it has three main elements here. Number one, it has a mandated tax life, generally shorter than the economic life. So for GAAP, they're using the economic life of the asset, and for MACRS here, they're using a tax life, and that's a predetermined life here by asset category or whatever your asset is. They have a predetermined tax life for it. Number two, the cost recovery is on an accelerated basis. In number three, an assigned salvage value of 0 to your asset here. You depreciate your asset to a 0 value, no salvage value at the end of the MACRS life here. So let's just go and look at a typical tax table here, and these are the percentages or of depreciation that you're allowed here per year here in this case. So first off, let's just look at it here, identify the elements, and then we'll go and look at the definition of these. So what we would have here, of course, we have our years shown here, and then we have a particular or a specified percentage of depreciation allowed here for each of those years here by class here. And property class, what we're talking about here is 3, 5, 7, and so on here. These are called property classes, and what we mean by that is each group of assets, or the government would have, the IRS would have defined here, like for a 3-year life, that might include, they'd have a listing of assets here that might be tooling or small equipment for the shop, or in the office, desks, computers, and so forth. And then as you move down the chart here, it's identified here as a property class here by number of years here, and that's the depreciation years here on those asset classes. You might get up to 5 years here, cars or trucks or something like that, and then 7 years might be other, like machinery or equipment or something like that. And then, okay, you've got your property class identified here, and then you would have the depreciation method here. Either we'd have it would be declining balance most of the time here. There are some options here. And then for the method, you'd have your particular convention, like, for example, here, the declining balance we're looking at on this tax depreciation table here as a percentage, a mid-year or a half-year. You could also have like a quarter of a year as well, so that would require a different tax table here. So let's go and look at our definitions here. So again, MACRS depreciation, you reference the IRS publications here for determining how you depreciate your asset here for this MACRS system. So A here, you have these different options here. So for A, that's a general depreciation system, and it's referred to as GDS. Or you have B here, and an alternative depreciation system that would be identified as ADS. And then we have two different methods here. Number one, you have the declining balance. That would be like for your mid-year and your mid-quarter depreciation. And number two here, you have a straight line option. You have an option to go to the straight line, and that could be like for the mid-year, mid-quarter, or mid-month. And what do we mean by mid here? Mid means whatever period the asset is placed into service, you use the middle date for that period. So for example, if we're looking for mid-quarter, we'd have to identify which quarter. Say it was the 4th quarter, so then we would have October, November, December. And when we mean by mid-quarter, we'd be using the middle of the quarter, or November 15th, as our depreciation date here. And then the other item here, each item of depreciable property belongs to a property class here, or a defined life. So what we were talking about before, the property class, for example, a car or truck that's being depreciated, it would go into a particular property class here, or have a defined life according to our depreciation chart. And just looking at what's tied in here, so this MACRS property class, we have say particular property classes here, and what what's tied into this here, the depreciation method depends on the property class. So whatever depreciation method you have depends on the particular property class. And just showing here in general terms here, our say our 3, 5, 7, and 10-year property here, you use a 200% declining balance here according to the IRS depreciation percentages per their charts here. And then for like 15 and 20-year property, you use 150% declining balance, and then the 27.5 to 39-year property here, classification here, you use a straight line here. And then one last point here, the recovery period for most property generally are longer under the ADS option here than they are under the GDS here. So let's go back to our table tax percentage table here. Again, this here, let's just go over it here in a little bit more detail. We have the property class. Remember, property class is defined by years here, like we got 3-year, 5-year, 7, 10, 15, and 20. And then the method here, well, in this case we're looking at this table here, it's a declining balance, and then we have the convention here. In this case it's a mid-year or half-year convention. So when you're setting up your depreciation here, you have to determine, select the proper table here based on the method here that you'd be using, like declining balance here, and there are options here for straight line. And then the convention, well, it depends if you're talking about mid-year versus mid-quarter. Each one of them has its own table here for depreciation. Okay, let's look at it a little closer here. So we've got our years here, and then for each year we have the percentage of a depreciation allowed here. And the point we want to make here is that these are our depreciation rates here by year here that are allowed, and then we depreciate our asset to a zero value. See, these tables are set up such that you take your whatever property class or asset you have, it depreciates it down to a zero value. There's no salvage value. It just depreciated it totally down to a zero value here. And you're going to notice here, it does it through what they call a switch over to the straight line depreciation. And the tables have built into them those percentages. So you can, I got them just marked here. You'll see a constant percentage, like under the 7-year, you'll see a 8.925 percentage, and you'll see them in 3 years in a row. Well, that's based on this switch over to straight line, such that you depreciate your asset down to a zero amount. And so all you have to do is pick out your, define whatever asset you have, define the property class here, make sure you got the proper table method here for the table for the property method that you were using, and then the proper convention, be it a mid-year or a mid-quarter, so forth. Then, okay, we went over this switch over to straight line depreciation. So if you see these in the table, that constant percentage for a number of years in a row, you know why, because you're switching over here such that you get a zero zero asset value at the end here of the at the end of the property class or the asset's life here. And then again, remember these tables here, you have to reference them to the IRS here. These tables are published. They're published all over on the internet and so forth. Go and you reference the table here and make sure you get the proper method here and for the proper convention here, and then you pick out your property class here based on the method here and the convention. And then one other thing here, when to make it a little easier here, when you're using or trying to calculate your tax depreciation on a particular asset, just go to the internet and find there's many Excel available online depreciation schedules, or it calculates out your depreciation here and lists it. So what you would be looking at here using this Excel method or whatever method you're going to be using, you would have your asset class. You have to determine what class of assets you have here, and that ties into the recovery period here is defined here by this asset class here. And then you work your depreciation basis here, plug that in here, and then you have to determine your depreciation method, be it declining balance or straight line, and then the convention again here. For straight line, there's some more allowances here, like you'd have mid-year, mid-quarter, or mid-month here. And then in the case here where you have like the mid-quarter here, you have placed into service, then you define what quarter that you're putting it into, first, second, third, or fourth here. And then one other thing here, you have your declining balance factor here, in case, 200% versus 150%. So again, make good use of any of these Excel tables that are available online here for calculating out your depreciation here, or to cross-check what you're doing here. And then one other thing here, going back to the table here, again, remember that's issued here by the Internal Revenue Service, and that's you would use these here, again, depending on what asset that you would be depreciating. And again, for tax purposes here, these are specifically for your tax accounting here, and your book accounting or your GAAP, you would just go back and use your regular methods. But for tax purposes, you have to use one of these modified accelerated cost recovery system tables here.